Looks like I got disconnected the first time. Let's try this again. Looks like I got disconnected the first time. IG kicked me off for some reason. So I have to share these links again. Alright. Okay, we're back. We're back again. Attempt number 2, round 2. Attempt number 2, round 2 here. Okay, so submit your questions in the question box. You guys should have some area where you can submit your questions, and I'm gonna go through them one by one. Okay, we'll just start going through them again. Question from Augustin Kior. How can I break the break-even state? How can I break the break-even stage? This is a poorly worded question. You're saying, how can you excel your trading journey past the stage of constantly not seeing any growth? I've said it a million times. I'm going to say it a million more times. You have to focus on learning. Now, a lot of you in this modern age, especially with social media content and a lot of the short form content that's being fed to you on various platforms, a lot of you are confusing consuming versus learning. I was just having a conversation with somebody who's asking me for help with their trading, and they're the exact same age as me, and they started trading a similar time as me, but we're completely night and day different in our level of market intellect, experience, and our skill sets, right? And I was talking to him, I was like, hey, just to let you know, I'm not intellectually gifted. I'm not someone who was born with a very high IQ, or someone who excelled during school, or someone who has like photogenic memory or photographic memory, right? I'm not naturally intellectually gifted. And I told him that the only difference between you and I is an extreme level of difference in work ethic, in focus, where I've actually been spending the last 6 years sacrificing countless hours of my day, countless days of my life overall, to actually learn about the industry I'm involved in, to learn about economics, fundamentals, psychology, to learn about myself, have hundreds and hundreds of pages of notes written, have thousands of webinars done, content shared, information development with the markets, trading, and so forth. So a lot of you have zero fucking knowledge about what you're trading. You just trade basic technicals, or you just got introduced to the markets through social media. You've been trading for 6 months to a year. You keep going break even or crashing accounts, and you feel like you're so hopeless and lost, but you've never spent a good amount of time actually learning about what you're trying to take advantage of. You spend all your time doing nonsense bullshit, right? And people who struggle with over risking and over trading, it also comes from a lack of foundational knowledge, because you don't know how the market works and behaves. You don't know how to adapt to it accordingly. You don't know how to use economics or fundamentals to your advantage. You don't know how human psychology is taken advantage of within this market and why 90% lose. You don't spend time or effort to learn any of these things. You're just constantly going in circles, watching. You watch a few bits of information here. Oh, Capitalhungry just posted a quick little gold video. Oh, nice. I just learned something. No, you didn't learn anything. You consumed some content I may have shared, but are you retaining the information? Are you taking notes on it? Are you going and back testing that information on the charts? Are you reviewing your notes and going back towards them again? Are you doing any of these other methods of retention rather than just watching? Probably not, right? Next question. Zafran. Hello, bye. Gold trading, it's haram? I'm not sure how to answer this question. I'm not of Islamic faith. I'm not religious personally. I'm Indian background, born in Canada. and my religion is economics. But I don't know if it's haram. Maybe. I think we were having a talk about this in Capitalhungry banter one time, but I don't want to get into a religion debate now. Question from Lenway underscore in. Oh, question from Lenway underscore. In terms of market volatility, how do you feel this first quarter will play out? Market volatility has been high and will continue to be high ever since the start of the pandemics, where central banking monetary policy has taken the most action and taken the most weight in terms of narrative of what's moving the markets. So ever since when the pandemic happened and the markets crashed and set up this crisis and opportunity for the rich, and you had all these central banks with their rates at zero, rates in the negative, increasing money supply, pumping the markets through their asset purchase program, the wealthy and the rich riding that wave from these crash points with these loans at zero and all this money being pumped into the market, right? That was the main driving factor during the start of the pandemic in terms of the majority of asset classes we saw. At the start of the pandemic, the money pumping, just to keep it simple, from the central banks and propping up the markets and the whales riding that wave. That's why stock market was so bullish, real estate was so bullish, crypto went to 70K in the example of Bitcoin, gold went to $2,000 an ounce, and now what we've seen over like the last year, especially in the 8-month period from 2022 to around November 2022, is the markets were pricing in the shift of monetary policy. The central bank switching into rate hike cycles and, of course, tightening financial conditions. And we saw during that phase, dollar domination. We saw, of course, dollar appreciate to 20-plus year highs. Stock market enter a bear market and correct to pre-pandemic highs. Gold go down to $1,600 an ounce. Crypto go down with Bitcoin back to 15K. So all I'm trying to say is, we still have extreme volatility and have had volatility for the last few years, ever since the pandemic started and central banking took over with such monstrous monetary policy easing and stimulus during the pandemic crash and crisis, and then such aggressive, heavy monetary policy tightening with the rate hike cycle and all of that. Right? So volatility is always going to be high. Macedonian, how do you compare the market trading with the gym working out? It's very similar in a sense where you have to have good foundational knowledge of what you're getting into. Now, this is a great little example to talk about. Most people enter the gym the same way they enter trading. It may be through a referral. It may be through a friend. You may have seen some advertisements that have swayed you to get in better shape or get a body that you want, that you may find desirable. And you may go into the gym one day and start fucking around in the gym. You don't really have good form. You're not really learning about anything you're doing. You may just mess around in the machines. You may start watching some YouTube videos here and there and then working your way up from there. Now, there's nothing wrong with that, but it's not the most efficient path for you to start your workout journey and your exercise journey to attain a better physique. What you should be doing is first gaining some foundational knowledge of the science of muscle building, the science of nutrition, actually learning about various exercises and how to do the correct form. First, you should be learning all of that. Learning as much foundational information as you can about nutrition, muscle building, exercises, what your goals are and how to achieve those goals, whether it's looking to put on mass or to remove fat, whatever it is, right? You should be first learning as much about that. Then, after you have that foundational knowledge, then you should take it to the gym and be applying it day in and day out, and you have the highest chance of, with consistency, seeing success over a long period of time, right? Obviously, you have to continue to challenge yourself. You have to continue to take on more stress, tension, and pressure. That's how muscles grow. You have to feed yourself correctly and be very disciplined in that sense. And that's the same approach that people should have to the markets. With the markets, most people get introduced to the markets maybe through a friend, maybe through some social media ads, and they may watch a few videos here and there. They saw a YouTube video and they think they're learning something or they think they're doing something. They think just because you can sign up at a broker and download MT5 on your phone that it makes you a trader. Just because you can walk into the gym doesn't mean you know what the fuck you're doing in the gym. Anybody has access to the gym. Just like anybody has access to enter into the markets. Access doesn't mean you know what the fuck you're doing. This is a big confusion for a lot of people, right? So then people come into these markets, they don't really understand what they're doing. They don't understand the science of the markets. They don't have any foundational knowledge. They don't even know what they are trading. They just know you can potentially put some money in to make some more money or lose some money. And then, just like people who have not spent time and energy to learn about the body and exercising, you're pretty much involved in the markets. You can be walking into the gym, but you're like a chicken with your head cut off. How many of you, right, be honest, go to the gym consistently, have developed your bodies, and you go to the same gym in your city or wherever you live, and you notice that you see people all the time, you see a lot of regulars, and they never show any signs of improvement. They still may have the same gut. They still may look really skinny. Yeah, that's great. You're there every day. Okay, that's fine. That's step number one. But I've been going here 3 years and never seen you make a fucking change. Like, eventually you have to actually gain some knowledge base, gain some understanding, challenge yourself, continue to elevate and grow. And a lot of people in the market are like those people you see at the gym every day where, yeah, you're here. You're in the market, you got your MT5 out, but I've never seen you fucking develop yourself, grow, sacrifice, make any changes, try to challenge yourself. You're in here doing the same stupid moseying on shit, and then you're wondering why you're not seeing any success or gains, right? So the working out and trading is very similar in this sense. T.PGN. Is trading Forex similar to the stock market in terms of price action? Listen, no matter what asset class you want to trade, it all still comes down to risk management, personal psychology, and your trading style. This is a very broad question. Are you scalping the stock market? Are you day trading it? Are you swing trading it? All of that is a big factor in terms of how you are attacking the markets, right? What is your risk? Are you focused on a high win rate, or are you focused on a positive risk versus reward and a lower win rate, understanding you have room for error and can sacrifice losses and still remain your emotional neutral control, right? So every asset class, no matter what asset class you want to trade, it's all the same shit. The financial markets are the financial markets. Every asset class is driven by real world information, the institutions and their order flow deriving from this real world information and events, human psychology, corruption, greed, power. That's what's going on in running these asset classes and markets, right? Doesn't matter if you're trading stocks, bonds, currencies, commodities, equities, like it's all the same shit. Abdul_Sammy_Nazir. I deposited $100 but lost just because I couldn't control my emotions and got panic. How to control? Number one, your picture looks like you're a 13-year-old prepubescent boy. First, go through fucking puberty, maybe go work a real job, learn about the value of the dollar. A lot of you keep talking about crashing accounts, keep talking about losing money, and you look like you're still 19, 20 years old. You're in school, you never worked a fucking job, you live off your fucking parents, you have no value of the dollar, right? Well before I started trading, I'm 28. I've been working for 15 years of my life in fucking lumber yards, in retail stores, in restaurants, in fucking, you know what I mean? Everything and everything in between, in offices, in warehouses. What this has done for me that a lot of the new generation doesn't understand is generate in value, like so much experience, so much understanding of how the world works, so many different perspectives of different people, and their viewpoints on life, understanding of the dollar and how hard people sacrifice and work for the dollar, gave me great work ethic, gave me great discipline, gave me great perspective on life of also understanding how to go out and get more, right? So a lot of you, you're 22 and you just got a job since year one. Like, you're 22, bro. You don't even have any emotional control in your day-to-day life. You look like a child, right? Focus on your day-to-day psychology first and become more disciplined in that sense and gain some real life experiences. The markets is a privilege. The markets is an extra opportunity, right? So St. Louis Du Bois Chris, can I try your subscription service for a month, or am I locked into recurring payments? There's no free month trial. If you're asking if you can sign up for the Capitalhungry Market Research Group for a month and then leave after the first month and cancel, of course you can. It's up to you. If you just have to make sure, like any other subscription-based service out here nowadays, that you cancel before your renewal date. So let's just say you sign up today. I don't know what the date is. Today is January 20th. You sign up today, January 20th. You pay the monthly fee. Your subscription is active until February 20th and will, of course, renew on February 20th. Right? So you have to go into the system, cancel the auto renewal before February 20th. You have 30 days to do that. You can sign up and pay for the first month and then cancel the renewal right away on the first day if that's what you want to do. It's all up to you. The reason why I made it a subscription-based service is to give you more freedom. You don't feel like you're locked into something. You're not wasting your money where you paid for like a yearly or lifetime subscription and you don't get the value. You can come and go as you please. And it also means that I have to keep the content quality at a gold standard for people to continue to use the service. Because if I don't keep the content, information, trade ideas, education at a gold standard, then people will just leave. No one will want to use the business, right? Raja Bank, send me a DM, bro. Me and the real Raja talk every day. Mali mentality. Why you ain't in the gym tonight, bro? I'm going after this. I even got a new gym fit on. You can see Majin Buu on the Nike swoosh. I'm going to be rocking this for a leg day after this. Harsh D Hat 11. What's a tip you use to avoid fake outs? My directions seem to be right, but entries are too early. I like to go down into the lower time frame, more specifically into the 1 minute time frame. First, I understand based on market sentiment or what fundamental events are in play or lack of, whether we have high volume or low volume. Understanding market conditions based on real world fundamentals and understanding if there's fundamentals in play that we have higher volume to play translates to easier movement on the technical charts, easier trends to play. So what do I mean by that? Let's just say today I'm looking to scalp gold and we have some CPI data. And I understand fundamentally some various scenarios with CPI and how to use it to my advantage. CPI comes out lower, it feeds into the Fed pivot narrative, it makes dollar weak and gold bullish. I don't have to enter anything right away. What I do understand is now, as well as for the next few hours and even into the next daily candle, this fresh set of economic data feeding into a fundamental narrative is going to bring volume into the markets and give us some cleaner conditions to trade and healthier volatility to trade, right? So then I understand during this period of higher volume, when I dive into the lower time frame, you have a higher probability of breaking out of key areas and also sustaining those breakouts and starting to form more of a trend. which is exactly what we saw happen on gold over the last couple of weeks. Improved inflation reports feeding into Fed pivot narratives, having other economic data weakening and becoming further into recessionary scare data, also feeding into Fed pivot narratives, this leading into the markets adjusting their order flow accordingly from an institutional algorithmic perspective, where you have less demand in the dollar, more demand into gold, and then we saw gold a lot more bullish, right? But on the flip side, I also understand that if we're coming off a bank holiday, if we don't have any economic events in focus, if reactive headlines are quiet, if I'm noticing from a technical perspective we're in intraday ranges or we're not really in a clean trend, then of course there's going to be a higher probability of more fake outs, of less sustained movement because volume and volatility is lower due to a lack of events. So you have to understand that. And the better you understand conditions, the better you can adapt to some of these technical movements, like not falling for a fake out or taking advantage of an impulsive move because you know the volume's in play. All right? Fed pivot. Do you still think it's going to happen by February? It doesn't matter if the Fed pivot happens by February or if they even start to pivot. Why doesn't it matter? Because the market has already been pricing in the chance of a Fed pivot since November 2022. Remember, the main reason the Federal Reserve has been raising interest rates is to combat increasing U.S. inflation, right? U.S. year-over-year CPI was nearing high 9%, almost 10%, which is high-risk levels, not hyperinflation levels, high-risk levels where if you don't start to combat it, it can spiral out of control in a very aggressive and volatile fashion, accelerating into hyperinflation levels in a very short period of time. So the Federal Reserve, the central bank working in hand with the government, the corporations and institutions down the line, they were starting to front load rate hikes during the first few months of 2022. The market was pricing that information in accordingly over like the months from April 2022 to November 2022, right? Markets were pricing that in. That's what we were calling the dollar domination phase, when there was way less demand in these asset classes such as gold or oil or the stock market or crypto because you have the Feds front loading rate hikes, the market's already pricing in that information accordingly, and you had all the demand in the US dollar at the time. Euro USD went to parity point, 1-to-1 with the dollar. Dollar individually soared to like 25-year highs and so forth. But ever since November 2022, we have had events come into play that have been feeding into the Fed pivot narrative. There's two reasons or two catalysts of events that would lead to the Fed pivoting and potentially stopping rate hikes or reversing their rate hike path. And what the market wants, as it would lead to more stock market bulls, more stimulus and better investing conditions, right? It feeds the greedy stock market narrative, that corporate America narrative, that Wall Street narrative. But there's two main events. One, you either have consistent proof that the Fed's front loading of rate hikes is doing its job. What job is that? Well, the job of bringing down inflation. So every time you have CPI reports now that have been showing decline and drop, it's showing the market the Fed's front loading of rate hikes is working, and they already start pricing in the higher probability of a Fed pivot or a slowdown of rate hikes or a less aggressive rate hike, right? Or two, you have the U.S. economic state so weak that it cannot handle any more rate hikes, and the Feds need a pivot to support the economy and prevent it from spiraling into a crash. So either one, you have consistent proof of inflation decreasing, which we have been seeing from November onward. Even the last CPI report was showing decline. Hence, it fed into the Fed pivot narrative, leading into dollar weakness, gold upside, stock market upside at that time as well, right? Or two, recessionary scare data, showing that the U.S. economy is too weak and cannot handle the rate hikes or that investing environment and tightening of financial conditions the Fed is doing, right? So now, Just to give a little bit of macro intel, just to give you a little bit of insight into the future, just because inflation is starting to drop right now and has been dropping since November, doesn't mean the fight on inflation is over just yet, right? There's been plenty of times seen in history before where the feds have done aggressive rate hikes to combat inflation. Inflation starts to drop. The Fed starts to pivot to support the market narrative and let the stock market turn bullish again. And then inflation starts to exponentially rise even higher again. So overall, the fight on macro inflation is still going to be episodes, in my opinion. It's not just going to be a consistent linear drop all the way to the Fed's macro goal of 2%. Remember, the Fed's goal is to bring year over year CPI back down to 2%. And even though we've been seeing consistent decline, we're still sitting at high 6%, low 7% on that CPI, right? So yes, we're showing consistent decline. Yes, we're showing that the front loading of Fed rate hikes has been doing some work on inflation, but we're not close to the 2% goal just yet. And inflation can still have some very aggressive episodes as the economy deals with a recession, as we have still other geopolitical tensions come into play, as we still have a lot of these asset classes very bullish and so forth as well. But anyways, going back to your question, the Fed pivot narrative has already been getting priced into the market ever since November CPI report was improving and other U.S. economic data such as PMI figures and retail sale and consumer activity has been declining. The Wolf on Forex Street. For seasoned traders with no capital, do you recommend a prop firm? Can you read that question out again and say if it makes any sense? For a seasoned trader, meaning a trader who's been in the markets for a long period of time with experience and more than likely successful with no capital. How the fuck does that make sense? It doesn't make any sense. A seasoned trader would have his own capital. What was the best trade you have ever made? Pretty stupid question, pretty irrelevant question. It's not like trades are like fancy cars you collect. Day trading is my job, right? Day trading is my job. Taking a winning trade is like a mailman delivering the letters every day. He's not fucking celebrating every time he delivers a letter. Now, yes, I've had some great trades and so forth, but nothing that's that memorable or where I have that type of focus on it where I'm like, oh man, that was the best trade of my life. Like, I don't think the mailman every day remembers some great house he delivered mail to and goes like, oh, that was the best house I ever delivered mail to. Like, this is your job, right? A lot of you guys have the wrong perspective in the markets. Think you can explain the difference between volume and volatility. Volume is size. Volatility is speed. Okay? So volume is the amount of orders entering a market. Volatility is the potential speed the market is moving at due to whatever conditions are in play. What is ideal is having high volume and high volatility. How can you tell the difference? Well, for example, you can have periods of high volatility but little volume. This can be translated on your chart from a technical perspective where let's just say gold's in a range, right? And you're still stuck within this 4-hour range. It's a large range. It could be 150 pips, 200 pips, but you're not breaking out of the range. You're not having a clean trend. You've just been consolidating, accumulating order flow for a period of days, even weeks. We could see gold range for periods of times, right? High volatility, low volume would be having aggressive movements in that range where you could have a 1-hour candle go to the top and the next hour reject down. You still have high volatility. You're still getting that market movement, but it's not consistent with the trend or extending the trend any further as you don't have that volume to sustain price moving further, right? But when you have high volume and high volatility, or just periods of high volume, this is when you continue a trend on the intraday and higher time frame, more than likely influenced by a fundamental catalyst, right? So volume is the amount, the size of order flow entering the market, which can be validated by continuing a trend, printing new highs, pulling back to a previous high, and then or collecting more orders and continuing further. You're seeing volume continue to enter on the buy side in a bullish trend, extending price up higher. You have the order flow to sustain that. Where volatility is speed, market movement that can be very aggressive or very fast due to a headline coming in or news, but doesn't necessarily mean it's going to lead to any significant further movement if the volume is not there. What is your call on the Bitcoin rally? Bitcoin in crypto is having a bit of relief from very significant lows printed. I highly advise to watch the Crypto Crash webinar for free on the Capitalhungry YouTube, which we called Bitcoin going from 60K down to 15K. I don't think the bottom is in on crypto yet. The reason why Bitcoin is rallying is the same reason why other asset classes were rallying. It was the hopes of the Fed pivot narrative being fed with declining CPI and recessionary scare US economic data. This is why you can specifically test Bitcoin intraday movement, and you're going to see the very aggressive hop and upside last really came from the improved CPI report. Right? So I don't really think that the Bitcoin's going all the way back to its highs yet. I think there's going to be a lot of these waves at these lows that traps a lot of retail liquidity, that brings some volume back into crypto with hopes, as volume ever since the crash and ever since all these various exchange scandals has been very low. The crypto markets have been very illiquid. So these little bounces, these little dead cat bounces you can call, really just start to bring in a lot more retail liquidity, really start to bring in public interest from these lows. But I don't think crypto's fully capitulated just yet. I think you can still generate some more liquidity, dig a bit lower. Then when optimism in crypto is really dead, that's when from those low prices, the whales are going to jump back in, and you're going to see it slowly start creeping back up over the next period of years, right? That's what I think. From macro level analysis and bias, what is the smallest level of lower time frame for trade execution? 1 minute time frame. But not just 1 minute time frame at any random price point, not just looking at it right now with where the charts are. Obviously the markets are closed now, but you get what I mean. Looking at price action on the 1 minute time frame at higher time frame or key price points of interest based on market structure, liquidity zones, and so forth. Right? So I'm not just looking at the 1 minute time frame all the time. That's just a waste of time and energy, a lot of noise and so forth. But when I'm coming to a very key retest of structure, a very key retest of a historical price point, a very key retest of a price point of interest based on pre-planned analysis or expectations with data, that's when I'm diving down to the 1 minute time frame, and I can get the best confirmations of buyer or seller control based on the price action and patterns that form and what it tells me about order flow entering the market at that time. Jozel CHCH, man, how do you manage your risk management in your daily trades? I personally am a day trader. I focus on a risk versus reward system and having a positive RR rather than having a high win rate. When I first started trading and it was introduced through social media, I was fooled to think that to be a great trader or to be consistently profitable, you have to have a very high win rate. You have to go on these huge win streaks. You have to win 90% of your trades. And all this does to you from a psychological perspective is put pressure to perform, give you a lot more limitations and little room to breathe, And also, when you finally do take a loss, you cannot accept that loss and manage that loss accordingly as a business expense. You instead turn it emotionally because you had all this pressure to be perfect. You had all this pressure of a win streak. Now this win streak's coming to an end. You can't accept it emotionally and psychologically. You crash and burn. What I've learned over the years is focusing on a positive risk versus reward ratio and having a sustainable win streak, a sustainable win percentage of 45 to 60%, right? So I focus on a 1 to 3 RR, or even higher, the better. But it depends on market structure. It depends on the volumes. It depends on what the market's going to be giving you. What the example is, let me give you just a rough bare bones example. I strictly trade gold. I'll be looking for 1 to 3 RR day trades. That means I'll stick to a rough, depending on market structure, 20 to 25 pip stop loss, and my TPs are 60 to 70 to 80 pips, right? I understand that if I stick to pre-planned analysis, only execute trades where I was looking to execute trades on, set my hard stop loss and my hard TP, that if I trust the risk versus reward over a stretch of 100 trades, I will be profitable as long as 40 to 50% of those trades win. That's a pretty reasonable ask, rather than hoping 80 to 90% of your trades win. I know that over a stretch of 10 trades, as long as I can accept the losses at the 20 pip stop loss and don't remove my stop loss and don't double down and don't increase my lot and don't revenge trade right away, I just accept the loss at the 20 pips. And I know if I just let my wins hit the TP, that out of a stretch of 10 trades, even if I lose half of them, 5 of them, I'm still very profitable, consistently growing my account and earning money because my wins are triple the size of my losses, right? So that's all I focus on there. And obviously the higher risk versus reward, the better, but don't start entering this smart money concept shit where they just show you some trading view charts of like a 1 to 30 RR and they show you some bullshit 4 pip stop loss and some 300 pip TP. That's not realistic. That's going too extreme on the RR side, trying to be some fucking hero just to show shit publicly for your ego, right? 1 to 3, 1 to 4 RR for day trades, having a 20, 30 pip stop loss and having like 60, 80 pip TP, that's realistic. That gives your trade room to breathe. That gives you possible understanding that pullbacks can occur, that you can retest your area multiple times. These people that show like these 5, 10 pip stop losses and 300 pip TP saying SMC, you know they're not live because fucking spread is like a few pips. One candle just quickly spikes down with spread and that trade's out. Like it's not realistic. They're stupid, right? But as long as you're still focusing on a positive, realistic RR, for scalps, 1 to 2, 1 to 3 is great. For intraday, 1 to 3, 1 to 4, higher is better too. But don't try to do this extreme bullshit. Oh, I got a 1 to 40 RR trade. No, you fucking didn't. Show where your actual stop loss and things like that was, and show doing that consistently, you know? Do you agree that 1 to 2 trades is one of the best reasons for being profitable? If your trading style is scalping, then you have to understand that overall in the markets, less is more. A lot of people bring this mentality from working a job or going to school into the markets. A lot of us were forced to go to school and go to classes for 8 hours a day and do mundane work. A lot of us, when we work jobs, are used to getting paid for our time. You get paid for clocking in for 8 hours, for doing mundane, fucking stupid, mindless work, right? But in trading, you get paid for your skill. So a lot of people have this urge or need where they always need to be in a trade, where they need to trade every day, where they need to trade every session. And that's not how the market works. That actually leads to more losses over the long term than wins, right? You end up over trading. You end up having a higher chance of being emotional and so forth as well, right? Understand less is more, whether that's scalping or day trading. As a day trader, you might only get a couple trades a week, a few trades a month of good, proper setups that are running you a clean 80 pips to 100 pips or whatever it may be. And as a scalper, who says that, let's just say you take a winning trade on Monday and Tuesday, and then you come Wednesday and you're not really comfortable in the conditions or the price action you're seeing, who says you got to trade it? Who's forcing you to put your profit back into the market and trade it and trade unfavorable conditions, right? So you have to stay adaptive to the market conditions as well as your psychology. There's going to be some days where the market may be trending great, conditions may be great, but you're not 100% there mentally. You're not feeling fully confident. You're not feeling comfortable. You may have some shit going on at work, stress. Your wife may be bitching in your ear. Your kids may be yanking on your fucking leg. Daddy, daddy, come play. Whatever it may be. You may be sick. You may be exhausted and not rested properly. You don't think that's going to impact your decision-making process? You don't think that's going to impact your psyche? You don't think that's going to impact your execution? Of course it is. So I've always told this to people in Capital Hungry. There's some days where the markets may be having fantastic conditions. Everybody else may be taking advantage, but you're not in the right mental state to be trading, and you shouldn't be trading. You should wait for the best time when you're feeling comfortable, confident, and you're seeing your setups come to you as well too. You know what I mean? So yes, I do think that in the markets, less is more, quality over quantity, and people need to develop more discipline and control of when not to trade. I think developing the skill set of when not to trade heavily increases your overall discipline, your selectiveness, and your long-term success in the markets. Everything else is pretty much the same type of psychology questions. I highly advise go to the Capital Hungry YouTube channel and go to the self-development psychology playlist. There's tons in there that would help you a lot. Shaj FX, what's the fundamental reason for gold going up so much this week? Continuations from the previous week of declining inflation, feeding into the Fed pivot narrative, other U.S. economic data having deeper into recessionary scare fears, also feeding into the Fed pivot narrative, more demand into gold as central bank purchases of gold continue to go up as well, and you have less demand in the dollar. But I also gave full educational webinars on this for free on the YouTube channel. All the other questions are pretty much the same. I'll see all of you next time, alright? This is going to be saved. You can rewatch it as you wish. We went through some fundamental questions, some psychology questions, risk management, understanding probabilities and so forth. Talking about a couple of things here and there. So, take care.